glitches to sort, but I hope that you can hear us and get us live right now. Let's welcome today's specialist, who's going to introduce herself.
Thank you. Good morning, everyone. I'm Akello Judith Tracy, Supervisor Business Policy, and I'm here to take you through the newly assented tax laws. That is the Income Tax Act 1, Amendment 1 of 2023, Income Tax Amendment Act 2 of 2023, Excise Duty Amendment Act 2 of 2023, the VAT Amendment Act, and the Tax Procedures Code Act.
Welcome, Tracy. We'll just dive right into it. I'll just start with first things first. What does it mean, newly assented to laws?
Okay, by saying newly assented to, we mean those are the new provisions that have taken effect after presidential assent. It follows the budget process. When the laws are passed by parliament, they are sent to the president to assent to them. So they only become law after the president has assented and they have been gazetted.
Okay. Yeah. Right. So what are the specific provisions? Maybe we can go act by act or amendment by amendment.
Okay, we'll start with the Income Tax Act 1. I'll give you just highlights because if I go section by section, we can spend almost the entire day. Key to the Income Tax Act is the amendment to section 20 that removed winnings from sports betting from the definition of property income. Now that was informed by a court decision where the justices of the court said that if you're classifying an item, it should be in the same family. So gaming and sports betting has nothing to do with property. So we had to amend the law to remove gaming and sports betting from the provision that imposes property income. That's section 20. And then we also had an amendment to section 21, which was exempting the officers in the Office of the Directorate of Public Prosecution from income tax under section 21. So it means that those officers do not account for pay on their salary. Then we had an extension for the tax exemption or the tax holiday for Bujagali Energy to 1 year. They will have another tax holiday for 1 year. We also got an amendment in section 25 relating to tier 3 and the microfinance deposit taking institutions, to the extent that previously, due to the definition of financial institutions in the Financial Institutions Act 204, they were not classified as financial institutions. So their interest was not an allowable deductions. They could not expense it, whereas the financial institutions could expense it. Now, cognizant of the fact that these institutions actually do similar work like financial institutions by lending and actually earn through interest, they should be allowed to expense. So in a sense, you find that the URA SACCO can now also be allowed to expense the interest in that scenario. Then we had the repeal of section 27. Section 27 provided for initial allowance. What happens is that if you put your building or machines into actualization or business use, in the first year, you're given what we call capital deductions. So initial allowance is one of those capital deductions. Now, following the tax expenditure rationalization project, we are cutting down on capital deductions. So in 2023, it's one of those deductions that we've removed from the Income Tax Act, meaning going forward, taxpayers cannot benefit from initial allowance as a capital deduction. Then we had an amendment to section 29, which was repealing subsection 1A. That was a consequential amendment because it was relating to initial allowance for industrial buildings. And then we amended section 38. This is very key because we are capping the carried forward losses by the taxpayers. It's basically to the effect that when you carry forward losses for 7 years, which need not be consecutive, in the 8th year, you'll be only allowed to carry forward 50% of the losses. In a sense, you're accounting for tax on the remaining 50% of the loan. And then we will look at 86. 86A introduces tax on non-residents for digital services, what we've called the DST tax, digital services tax, at the rate of 5%. Now, this tax is imposed on non-residents, not residents of Uganda. It's basically non-residents, the likes of Netflix, Amazon, Google, and the like. So if they have sourced income, or they have earned income from residents of Uganda or Ugandans, we require them to account for tax on the gross income at the rate of 5%. They are not allowed any expenses, and there is a special return that is simplified, and then they will also be allowed to pay that tax in dollars. There was an amendment in section 73 that allows them to pay that tax in dollars, because our law only allows payment of tax in Uganda shillings. So it's an exception to the general rule, in line with easing compliance and simplifying tax of the taxpayers. We also had an amendment to section 118C that relates to withholding tax on winnings and bettings. So we've removed withholding tax on gaming because the tax point is not easy to come by, so it was making administration very difficult. But we retained withholding tax on betting. So the betting industry will have withholding tax of 15% and gaming tax of 20%. And then the gaming industry will have gaming tax of 35%. The other amendment was on section 136 by repealing subsection 8. That related to, it's a consequential amendment, the foregoing provision. Then we amended the first schedule to exempt ZEPRI reissuance. Now, ZEPRI is the reissuance company for East African countries. So it was agreed in principle that all the East African countries should exempt it from tax to ease doing business and to make reinsurance affordable. The third schedule was also amended. This is also a consequential amendment to provide for the rate of the DST, which is 5%, and remove the word gaming from the rate for withholding tax. So that's it about the Income Tax Act.
Okay, I just noted a few things that, and I'm curious, do they affect business when some of the amendments affect business, like removing initial allowance, IBD, and capping the carrying forward of losses? Could you just maybe comment a bit on the effect?
The answer to that is yes and no. Why yes? Because yes, of course, the taxpayer has been taking a benefit from that, and you'll find that most taxpayers have been declaring a tax loss provision. A tax loss position. And we all know that tax loss position is as a result of capital deductions. It's different from a business loss. So trying to cap it, we are trying to guard against consecutively declaring losses. You have companies that have been declaring losses for the last 15 years. Rationally, you couldn't be carrying on business for 15 years when you're in a loss position. And when you look at these companies, in reality, they're actually flourishing. The directors are doing well, the company is doing well, they're declaring dividends, but they are in a tax loss position. So it's basically to curb the aggressive tax planning that is going on in the country and elsewhere. And then when you look at the issue of initial allowance, it's in the same spirit. The country has decided to cut on tax exemptions under the tax expenditure rationalization project. So every year we will have to cut down on a capital deduction. So it's just one of those things that we have to do as Uganda to be able to afford to fund the budget.
Okay, so that's from the income tax side.
Yes.
There are some from value, from
The tax side. Yes. For VAT, the first amendment is on section 10. Section 10 introduces VAT on auction goods. Currently in the law, we have VAT on auctioneering services, where an auctioneer comes, say in URA, to auction the cars that we usually do during a public auction. They are required to account for VAT on their services. Now, this amendment says that when that auctioneer is auctioning that car, the auctioning price, there must be 18% VAT on the value of that car. Assuming this car has been auctioned at 10 million, we expect the auctioneer to add 18% of the 10 million and account for VAT on that. So it's basically an addition to the VAT on the auctioneering service. They have to be VAT on the auctioned goods as well. And there's an amendment to section 16. One is section 16 is a charging section for non-residents. We've been charging non-residents VAT without a specific charging section. So for clarity, we've created a charging section for VAT on non-residents. And then we've also expanded what we would call electronic services. It's an inclusive definition, so we've literally expanded it to catch up with the developing digital world, the ever-evolving digital world, and still left it as an inclusive definition. Maybe the other leg to point out is that we've removed educational self-study packages from section 16. What does that mean? Is that there is no VAT on self-study packages. Of course, that is to make education affordable and cheap. I wouldn't go into reading the entire provision, but that's the essence of section 16. We're expanding the definition of electronic services and creating a charging section for the non-residents. There was also an amendment to section 28. Section 28 relates to input credit. Now, there were two amendments to this section. One was in relation to where you pay membership. We are removing entertainment, payment for entertainment. The definition of entertainment has been widened to include payment for social clubs and sporting activities. Let's assume URA, which does, URA pays club memberships for the senior management to different gyms. Now, that gym, let's say Kabira, cannot claim input credit for the membership of a URA senior management member because we've excluded it by defining it as entertainment. Assuming the organization was paying membership for Kampala Club for the members to play sports and stuff, Kampala Club cannot claim input credit for that because it's been included in the definition of entertainment. And then we've capped input credit. If you're to claim input credit, it should be derived from that business. It should be, first of all, from the same business, and that should be the same business that is generating that income. I'll use an example. We all know Capital Shoppers supermarket, and we know that Capital Shoppers is putting up a Marriott hotel in town. Now, what this means is that the input credit or output tax for Capital Shoppers cannot be claimed under Marriott and vice versa. The one that relates to Capital Shoppers will be strictly for Capital Shoppers, and the one that relates to Marriott will be strictly for Marriott. Assuming they go a step ahead and venture into real estate, they can still not claim that input credit. Real estate will be capital alone and the supermarket alone. Now, Marriott can also not claim input credit until the hotel starts running and generates its own output. So that's the impact of the amendment on section 28. Then we have an amendment to section 65A, which is repealing subsection 2. Now, that was a provision on capping of interest and penalties as at 1st July 2017. Now, what is the essence of that is that going forward, that provision is not there. Besides, it was a spent provision. But this was also informed by our tax waiver under section 40D of the TPC. Then we have an amendment to section 73, which allows for payment of tax in US dollars, given that our law only allows payment of tax in shillings. So we are saying for the non-residents who we've imposed on tax under section 16, they are free to account for the tax in US dollars. We amended the first schedule to cater for ZEPRI reinsurance in the same spirit of East Africa to ease and cheapen reinsurance services. The second schedule was amended to impose VAT on diapers as a low-hanging good and in the spirit of revenue collection and protection of the environment. We all know that diapers are not biodegradable. So it's in that spirit that tax was imposed on diapers. We also expanded exemption on animal feeds. Just to clarify, to include, it's an inclusive definition to avoid any kind of misinterpretation, to include eggshells, feed additives, wheat bran, maize bran, premixes, concentrates, and seed cake. There was also In addition, the supply of billets for further value addition in Uganda as exempt, and we deleted the word cassava from ethanol. So it means every ethanol is exempt from VAT, irrespective of whether it's made of cassava, millet, whichever other raw material that you use. Yeah, that's it about VAT. The VAT Act 2 specifically relates to Islamic banking. And that's the same thing about Income Tax 2. It brought into effect provisions that related to Islamic banking. Since Islamic banking is a new industry or a new aspect in Uganda, wanted to level it with the traditional banking sector. Yeah.
So just to pick up on the Islamic banking, with these new amendments, does that mean that now the banks can start off the journey, or is there still some work that's still being done to prepare?
No, the banks are actually free to start. Like you saw, Sanlam has already been given a license by Bank of Uganda to start operations under Islamic banking. I know that the Microfinance Support Center is already on board with Islamic banking, and I'm sure most of our commercial banks are going to pick it up and get running.
Okay. So that's with VAT. Are there some for excise duty?
Yeah, for information, Excise Duty Act 2 was assented to by the President, and it also strictly relates to Islamic banking. The budget bill wasn't assented to by the President. We are still waiting for him to assent to it. And it's the same bill that was sent to him last financial year. It hasn't also been assented to. But what is in that bill, one, is that we expanded the definition of fruit juice to mean unfermented liquid extracted from edible part of a fresh fruit, whether the extracted liquid is diluted or not. We also defined what an undenatured spirit is, to mean spirits that are not mixed with any substance to render the spirit unfit for human consumption or capable of being rendered unfit for human consumption, and includes neutral spirits or alcoholic beverages made from neutral spirits that are fit for human consumption. And the definition of vegetable juice to mean unfermented liquid extracted from the edible part of a vegetable, whether the extracted liquid is diluted or not. This was basically for clarity, because you'd get taxpayers asking you now, what is an undenatured spirit? So we decided to define that, and what is fruit juice, what is vegetable juice. And then when you go to the second schedule, which is literally amended to put rates for different items, opaque beer was amended to give it 12% or 150 per liter, whichever is higher. New in the schedule is the introduction of a fixed rate for water, drinking water. Currently, we're having an ad valorem rate of 10%. So we've put a fixed rate of 75 shillings, Uganda shillings, and added that whichever is higher. What that means is that per liter, you will always have to pay 75 shillings because it's always higher. So that's the only new thing in the excise duty amendment bill. The rest are as was last year or as is. The law on plastics is the same because the President hasn't assented to it for 2 consecutive years. Yeah.
Just maybe one more that I was curious about. I don't know if it was assented to yet, confirmed. Something to do with exchange of information.
Yes, exchange of information was assented to. That is the Mutual Cooperation Act, mutual tax. The OECD member states came together and agreed that they should help each other in tax administration. So when the members signed the agreement, we had to domesticate agreements to be able to take effect in Uganda. So that was passed and assented to. So we now have automatic exchange of information. All the standards and the agreements are now domesticated in Uganda as law. Yeah, that is running. So I think our team in automatic exchange of information unit is setting up the system. We've had a number of stakeholder engagements, and yeah, the financial institutions are on board. We are hoping to kickstart in 2025.
I think it's time for questions. I don't know if there are any questions.
The TPC.
Okay, maybe you can give us some parting shots.
Okay, yeah, we still had the TPC. Before I go to the parting shots, the TPC was amended under Section 5 to require a TIN to register any instrument. Currently in the law, if you're going to register a land title, now you're supposed to provide a TIN, both for the transferor and the transferee under Section 510. Section 19B was also amended to penalize unauthorized interference with the digital tax stamps. We've had a scenario where taxpayers are reprogramming the digital tax stamps machines, those that are fixed stamps. So we're saying we didn't have a law to penalize that. We are now introducing one. We also have an amendment to Section 38(1)(a) to cause clarity by adding the words outstanding at the date of payment immediately after the word tax. And 38(3), these are allocation rules, if you've heard about them. Any payment by a taxpayer shall be applied in the order of principal tax first until it's fully paid. Then we have Section 40. Now, currently, previously, URA would recommend, where a taxpayer is unable to pay its tax, URA would recommend to the minister to waive that tax. Now, the parliament went ahead and added another level that the minister can only waive that tax after presenting it to parliament, the conditions. Then we have the famous waiver provision, Section 40D, that is providing amnesty to taxpayers who have paid their principal tax by 31st December 2023. They will have their penalty and interest waived. And this can be done pro rata. If you had interest and penalty of 20 and you've only paid the principal of 10, we'll only waive off the 10 and the other one will stand due. Please note that this is for the financial year that ended June 30th backwards. So for this current year, whatever interest that is accumulated, it's due and payable for any. Also that this doesn't cover interest and penalty as a result of a tax offense. There must be a principal tax. So if you've committed a tax offense, that provision does not cover you. The other provision that is key to the URA staff is Section 42, that provides the effect that where a taxpayer fails to provide URA with information that has been requested for during an audit stage, URA will not review that information at any other stage of its engagement. That means objection stage, alternative dispute resolution, or any other involvement. But we can review that information if court has instructed URA to do so, if we have a court order. So staff are encouraged to always request for information in writing and to be clear about which kind of information they would like the taxpayers to provide, so that at a later engagement in the organization, we can take benefit of Section 42. What we've been suffering from is that the auditors ask the taxpayer for, let's say, a loan agreement, and the taxpayer will pretend not to have it. Then after you've made a tax decision and they know that the reason you've made that decision is the agreement and they were looking at something in the agreement, the taxpayer will come up with an agreement. And at objection stage, a manufactured agreement will show up. So to avoid such, we're saying if you've asked you for a document at audit stage and you've not provided, we don't expect you to provide that document at any other stage. And then Section 62 is a penalty for someone who fixes and activates a tax stamp on a wrong product. You often find a tax stamp that is relating to water on a whiskey bottle. So we do not have a penalty for wrong affixation. We had a penalty for failure to affix and activate. Now we want to penalize affixing and activating on a wrong product. Yeah. So that's all about that TPC. That is key. The rest just additions that we've already had a discussion about.
Okay.
Yeah.
I think it's important to repeat that there's a waiver for penalties and interest should you pay the principal or at least a portion. I think that's an important aspect because many people have cried that since COVID, the recovery has also not been easy, even though lockdown has since passed. So we encourage you to take advantage of that. Is there more, maybe from lotteries?
Oh, the Lotteries and Gaming Act. I already talked about it in relation to the Income Tax Act when we repealed and removed withholding tax on the gaming industry, we had to increase the gaming tax for the gaming industry. And that amendment had to be in the Lotteries and Gaming Act. So that's all that was in the Lotteries and Gaming Act,
Okay.
a single provision, yeah.
There's a question asking that where can someone find some of this information?
Oh, this information is all over. URA website has it. If you go on the business policy page, you'll find updated laws. The newly assented laws are there. If you need any tax literature, as you enter any URA office, there are booklets that are written, some even translated in local languages. So you can get this information on any URA page currently.
Okay. So thank you so much for joining us. She's pointed out the URA website. There's also X, or formerly Twitter. You can also get help from LinkedIn, YouTube. There's a URA touch point. In any browser, you can just Google URA. Okay, you can just search URA touch point, and you should be able to get help from there. There are toll-free lines and WhatsApp. And just before we close, we can just get some parting shots from Tracy.
The parting shots would literally be compliance is cheaper than non-compliance, and knowing the law is one way to make it halfway to the sure things in life that are tax and death. We all know that tax is one of those sure things in life. Like, you will have to pay tax at some point in your life, and you will have to die at some point. So to ease your life to that sure journey, compliance is key, and that understanding tax is everyone's obligation in this country as we strive to develop Uganda together.
All right. Thank you so much for your time, Tracy. Thank you for what you highlighted for us. Please don't hesitate to reach out, and it's been good having you on the show today. Good day.
Good day too.